About recording, by the way, I noticed that there has been some issues with some of the videos, which were initially more than 1 hour. I could see them, you couldn't see them. So now I'm only posting like half classes, so that normally you should not have any problem with the videos. If you do have problem watching them, just let me know, but I think it should be all right. Okay, so what are we going to do today? We're going to start this new lecture about interest rate risk and duration. Just to give you a bit the outline, so that's what we did so far. So by now we should be able to price bonds using net present value of the cash flows. We analyze the yield curve, which is basically telling you how much investors discount cash flows at different maturities. Now we should know how to build it, or at least that you should know that after doing the problem set. And in last lecture, we studied the market for US Treasuries, and we said that there are reasons why we want to focus on this market, and we learned about some details of how the US Treasury market works. Now, in this lecture, we're going to move a bit from the static view. So why static view? Because so far we said, okay, we're at a date T. So today we look at the price of bonds going forward, and we build the yield curve for today, right? Even this yield curve, you can build your portfolio of bonds for investment, and that was a bit static in a sense. Of course, in practice, once you build that portfolio, you're going to be interested in how the value of this portfolio moves over time, right? So this is quite important. Now, in practice, there are many different sources of risk that this portfolio might be subject to. So if you think about corporate bonds, you have credit risk. But one of the main sources of risk in a fixed income market, even when you don't have credit risk, is interest rate risk. So today we're going to study interest rate risk, and we're going to see that we can come up with one synthetic measure to try to approximate how sensitive a portfolio is to interest rate risk, and this measure will be called duration. Okay. But first, to motivate a bit what I'm saying, I'm going to take a bit the counterpart of what I said last time. So last time when we talked about treasuries, I told you, why do people like treasuries so much? Because they are so safe, right? Of course, when I was talking about safety, I was talking more about credit risk, right? The fact that debt issued by the US government, nobody thinks that the US government will actually default on that debt, right? So that's what I meant by treasuries are very safe. Now, what I want you to do is to look at this picture that's taken from the book by Veronesi. And here we start in 1986 here. In 1986, the US government issued a 20-year bond, right? So a 20-year bond, and that's why you have the dates until 2006, which is, 20 years later. Now, what you see here on this graph is the price pass of this bond over the 20 years of its existence, right? In 1986, it's issued. In 20 years from now, 2006, it's paid by the government, right? And what you see here, right, is that the face value of the bond was equal to 100, right? On the date when the government repays, the government will repay 100, the value of this thing is 100. There's no time value of money. We're talking about 2006 when the bond matures. Now, what you can see from here is that, well, the bond was issued, almost at par. How can you see that? Because the price in 1986 was close to 100, right? So what it tells you is that when the bond was issued, it was issued at par. Okay. Now, what's important here is, what is the value of this bond along, it's this path that we see from the date it was issued to the final date, right? And what you see is that this price fluctuates quite a lot, right? So it can go up and it can go down, and you see that here the fluctuations were quite extreme in a sense. So what should be really clear is that if you buy this bond in 1986 and you wait for 20 years, you're going to get the face value back, right? That's not the problem. If you can wait, you're going to get the face value back. The question is, what if you care about the price of this investment in the meantime, right? Now, suppose, for example, that I buy this bond in 1986. I think I'm going to hold it for 20 years, but I need to sell it at that date, right? So I sell the bond here. Well, I'm not going to be very happy because the price of that bond will be pretty low, right? So I'm exposed to the price fluctuations in this bond, right? So again, the thing that should be clear out of this picture is like, it's not because a bond is safe in terms of credit risk that it's not risky in terms of other types of risk, right? Now, as I mentioned before, what is this other type of risk here? Well, that's why I plotted on the bottom of the slide, this other graph, where here you have, let me zoom a bit, you have the 1-year treasury rate, right? So I just want to make clear that, the 1-year treasury rate is not necessarily the relevant rate to look at to price these bonds, right? Why? Because when it's a 20-year bond in 1986, you should look at the 20-year rate, right? In 1996, for example, 10 years after the bond was issued, you should look at the 10-year rate, right? Because this is the rate that will matter for this bond. Now here, what I'm trying to proxy here is just, the level of rates, right? You can think of assuming that the yield curve is flat, so the 1-year rate at any point in time is also the 5-year rate, the 10-year rate, and the 20-year rate, right? So this is just a proxy for the level of rate. Okay, simple question. What kind of correlation do you see between the graph at the top, which is the price of the bond, and the graph at the bottom, yes, which is the interest rate? Okay, easy question. In the back? Oh.
I'd say inverse correlation.
Yeah.
When one goes up, the other goes down.
Exactly, right? So what you see here is that, at the beginning, for example, the interest rate went down and the price of the bond went up, right? Of course, the correlation is not perfect. One of the reasons I just mentioned is that the 1-year rate is not necessarily the rate to price this bond. But if you think about it as the level of rate, you see that on average, it works. For example, if you take this period here, rates are low. And if you look on the graph here, this is when the price is high. Okay. So, this is something that we all know. As rates move, the price of fixed income instruments will move as well, right? Again, the question is, why do we care about these price fluctuations? You might say, well, if I'm an investor with a long-term 20-year horizon, the price might fluctuate a lot in the middle, but I'm still going to get my 100 at the end, right? Now, reasons why you might care is one I already mentioned is that maybe you were thinking of investing for 20 years, but at some point you need to sell that bond, right? So you worry that you might sell it at a price that is too low if interest rate go up. Another reason is that for many investors, their portfolio needs to be marked to market. Okay, so you probably know what this means. It means that instead of looking at the book value of the securities on your balance sheet, we're going to look at the market value of securities on your balance sheet, right? This is to reflect the actual value of what you own and the actual value of your liability, right? So again, if you're an institution and your holdings are marked to market, it's not necessarily good news that the price of your holdings decreased so much, right? So what it says here is that, at the end of the day, even with safe bonds, you're exposed to interest rate risk, okay? So this slide just kind of says, what I said with the help of the picture. We said a government bond is safe because there's no credit risk. We also know that the price of the bond will converge to the face value at maturity, right? But before maturity, the price depends on interest rate movements, right? So this is our typical bond pricing equation. And if these rates move here, well, the price will move as well, right? So the question is, how much the price of the bond and ultimately our portfolio will change when the interest rate change. Okay. So just to tell you how important it is, this is taken from, you might think that this is, a picture taken from fixed income for dummies, but it's not. It's actually something that the SEC, the Securities and Exchange Commission, sends to investor in its investor bulletin to remind them, you never know that there is an inverse relationship between price and rates. Okay, so this nice picture tells you that interest rates go up. Well, for fixed rate bonds, the price of this bond will go down, right? So this is the key source of risk for bond. And of course, if it goes the other way around, if interest rate go down, the price of the bond goes up. Usually we mention this aspect a bit less because people think, oh, price of bond going up is kind of good news if I'm holding the bond. Okay. Now, just to give you another motivation, that it's not just, okay, I'm taking a bond and the price of this bond will fluctuate. This interest rate risk is a main source of risk for many financial institutions. Right? Now, suppose you're a bank here, right? And we're going to think about a very simplified, okay, that's not great. Very simplified balance sheet for the bank, right? Okay, hopefully the bank has some equity. Okay. Main source of financing is deposits. And here you have loans, mortgages as well. Now, what typically banks have is that they have long-term assets and short-term liabilities, right? This is property that is called maturity transformation. Okay. Now, these things will actually have an impact on the type of interest rate risk that they're bearing, right? So how to think about that? Well, these loans and these mortgages, traditionally, they are long-term with fixed rate. right? So which means that you're lending to a corporate, it's going to be a 20-year loan at a rate of 5%, right? And this coupon rate is not changing. Now the deposits, of course, they are short-term. Right? The most extreme form of short-term deposits you have in your checking accounts that you can withdraw at any time. Banks also have time deposits where you have to leave the money for some amount of time, can be 6 months, 1 year. But the idea is that these deposits are typically short-term. Okay. Now, what happens if interest rate rises, right? So that's what's written on the slide. Now, typically, your depositors will ask for a higher interest rate if interest rate rise, right? Now, these days, it doesn't seem very relevant because rates have been staying low for very long, right? So if you go to your bank and ask, I would like to have a 2% interest rate on your deposit, they will say, yes, sure. Try to get that somewhere else, sorry. Okay, but in general, if, the rates go up, you have to pay more interest rate on your deposit, so the value of your liabilities increase, right? At the same time, you can think of loans and mortgage as bonds with a fixed coupon on your asset side. What happens to them? Well, we just saw it. If interest rates increase, the value here goes down. Okay. So here the bank is exposed to interest rate risk because when interest rate increase, the value of the assets go down, the value of the liabilities go up. Right. So it's a typical source of interest rate risk that the bank is exposed to. And you might remember when we talk about the expectation hypothesis, we said that to invest in long-term bonds, you often have to compensate investors with a risk premium. Right. Well, one way to see this risk premium is that you're compensating the bank with a higher interest rate because the bank bears this interest rate risk. Okay. Now, if you're interested, you can read with the link that you have on the slide, an extreme case of this interest rate risk, which is what happened in the 70s, 80s to some form of banks that were called US savings and loans. Right? Now, what happened there is that a combination of two factors. The basic mechanism is the same, it's exposure to interest rate risk, but there were two aggravating factors. First, for this institution, the regulators wanted to limit competition. They wanted to limit the extent to which these banks could offer very aggressive rates to the depositors. So they put a cap on these rates, right? So if you went to this US savings and loan, they said, yes, sorry, I would like to, but I cannot pay you more than this, X%. So that was the first constraint. The second thing that happened is that in 1977, the US Fed raised rate a lot, right? So from 9.5 to 12%. Okay. Does anybody know why it made sense at the time to raise interest rates that much? Yes.
I think there was also high inflation during the time in the US of 15%, something like that.
Yeah, exactly. That was a time of very high inflation, right? So what did we learn? Well, central banks are supposed to fight inflation. How do they do that? They increase the rates, right? Now, so from a monetary policy point of view, that was perfectly justified, but that was pretty bad news for the Savings and Loans Association. So they had this, fixed rate assets on the asset side of the balance sheet. So the value of that went down, just like in the example I showed you. And the interest rate increased. So depositors were saying, okay, you cannot pay me a higher interest rate. I'm just going to take my deposits and put them somewhere else. Okay, what is this somewhere else? Maybe money mutual funds, or at least institutions that were not regulated in the same way, right? So this effect, in a sense, it was the same effect that we saw in this picture. The value of the asset goes down, the value of deposits go up, or even here you lose the deposits. And it's just to illustrate again that these institutions were heavily exposed to interest rate risk. Now, if you work in a bank, they wouldn't typically call that interest rate risk. They would call that repricing risk. But this is the same notion. This is the idea that you have to reprice your assets and your liabilities when the interest rate change. Yes.
Is this more of a US problem? Because I think it's one of the few countries that has fixed payment mortgages. I think many other countries have it floating. So is this a US problem? And I guess Denmark.
Yeah, so that's a very good question, and that's what I'm coming to. So no, but this is good. Like I like transitions, that's fine. Yeah. So what I was saying is that this is kind of the traditional view, or you could call it the US view, right? Because what was really important in the argument is that my asset had this fixed coupon, right? So I'm getting this fixed coupon, I'm getting this fixed rate on my asset side. So when the interest rate goes up, the value of that goes down, right? Now, there are ways in which banks can eliminate this interest rate risk, right? And one thing that you said is that, well, instead of having this fixed rate asset, I'm going to have assets with varying payments, right? So how do I do that? Well, I issue mortgage with a varying rate. I also go to corporations and I tell them, look, I would like to lend to you, but let's do it with a floating rate, right? A rate that adjusts as a function of the interest rate environment. So how does it change, the picture? Oops. So if you have, assets that have a varying rate, well, when the interest goes up, you also get more payments on this asset, right? So you don't have this effect of the value of your asset going down. Before, the interest rate that you were getting was set, at a fixed value, let's say 5%. Now, if the interest rate went up to 6%, you were still getting 5%, but you were discounting that at a higher rate. Now, if you have floating rate, if it goes from 5 to 6, now you get 6%, right? So you discount at a higher rate, but at the same time you get more. Okay, so that's a way to hedge against this interest rate risk. Now there are other arguments that have been put forward for why actually banks are not so much exposed to this interest rate risk. One of them is also that I said that depositors, if rates increase, they will go to the bank and say pay me a higher rate. But what people have found in practice is that depositors are typically very captive from their banks, right? It's not like they're going to change one day from the next, which means that if interest rates go up, banks do not necessarily have to pay more on their deposits, right? So again, it's another way through which they can be insulated from this interest rate risk. Okay. So again, the point of this slide is, first to get a view on kind of asset liability management for banks and financial institutions, and we're going to see more about that in the next lecture. But the point is to tell you that this interest rate risk is very relevant, and it is so for many financial institutions. Okay, so now the question is how do we measure it, right? So let me motivate a bit why it's not so obvious. Okay, that's again the relationship between bond prices and yields. Okay, now what you can do is you say, well, if interest rate move in a certain way, right? If the yield curve goes from what it is today to another pattern, I can compute the new price of the bond, right? So I can tell you if rates move that way, then the price will be this or that, right? Now the problem is that there are many possible ways in which the yield curve can move, right? So here I showed you how it moved more or less over the last year. Right? So in the blue, you have the new one, right? And what you see is that long-term rates have been increasing. And in orange, you have the yield curve as it was 1 year ago, right? More or less 1 year ago, because this is not the date of today. Right? Now, what's the problem here? Well, that's what happened ex post, right? But ex ante, many different things could have happened. So if you manage a portfolio and your manager asks you, okay, what is my sensitivity to interest rate? You cannot come back with 50 different scenarios. You cannot come back and say, okay, if the yield curve moves like this, only at long-term maturities, then this happens. If the yield curve moves at short maturities, then that happens. That will be way too much information, right? In fact, fixed income funds, they report one piece of data when it comes to interest rate risk, right? So if you click here, I picked a provider at random. I have nothing to do with Vanguard, of course. But this is just to give you an example of like fixed income fund, right? The one thing that I found was quite funny is that when they say, what is the fund's investment objective, is to seek to provide current income that is exempt from tax. So the investment mandate, I think it's quite interesting, but that's not why I'm showing you this. So you have a lot of data, of course, on this web page. So what is the risk? What is the growth of a fund? If you have invested $1 at a certain date, it shows you the cumulative return. But what I care about is this part here, right? The characteristic. So what you have here is that two things that we know already. We know about what is the average maturity. That's pretty easy. We know also how to compute the yield to maturity of an overall portfolio. But the other measure that you have here is the average duration. This one here, right? And this one is one single statistic that tells you how this portfolio is sensitive to interest rate, right? And that's actually what oops, that's supposed to work. Okay. It's a measure of the sensitivity of the bond or bond mutual fund price to interest rate movement, right? So that's exactly what we're talking about. Now we're going to see how we compute that, and we're also going to see why they can interpret it like this, saying that if the bond has a duration of 2 years, its price will fall by 2% when interest rate rose by 1%, right? That's kind of the synthetic measure that you want to come up with. And of course, we're going to see why this is the case. As I said, we want a single relevant statistic to summarize interest rate risk. So what's the basic idea? Okay. And there's going to be a bit of algebra, but nothing too complicated. At the end of the day, the most complicated thing we're going to do is take a derivative, right? So that should be okay. The idea is we're going to look at a particular change in the yield curve, right? Instead of saying the yield curve can move in many different ways, what we're going to say is that you start from a yield curve like this, we're going to tell you what is the impact of a change in rate. If all the rate change by the same amount that we call delta R, right? So that's the idea, right? Parallel shift in the yield curve. Then we're going to see, okay, is it a good assumption or not? We can discuss this, but that's what we're doing. Okay, so now, if you were to measure that empirically, what you would do is that you would say, okay, I have the price of my bond under the old rates, right? This is the first expression. You have it before the change. Now, if all the rates at all maturities increase by this delta R, now I have my price after the change. So how do I measure the sensitivity to interest rate risk in this case? Well, I'm going to look at the new price here, right? So this one after the change. I subtract the old price, and then I divide by the change that in rates that I consider, this delta R. Okay. So you might ask me, why is there a minus sign here? Right. The only reason is that we want this measure of duration positive, right? So why would it be negative otherwise? Because you look at an increase in rate, right? So if delta R is positive, well, the new price should be lower than the old price, right? So if you didn't put a minus sign, you would have a negative thing, right? So people just like to report positive numbers. That's why we look at the opposite of this relative change, right? Now, the key assumption, as I already stated, and that's what the assumption that we're going to work under most of the time, is that yields at different maturities move together, right? So this is the picture I showed you here. If the yield curve is any particular way and it doesn't have to be flat, all the yields at all maturities will change in the same way, right? By the same delta R, as you can see on the formula here. Okay, now some of you might already see that, this formula here. Oops. Wow. Really, that's the wrong way. The way we're going to go at this formula is to compute the derivative of the bond price function. Here, this is just like one approximation, but where we're actually going to capture this D, this duration concept, is with the derivative of the price function, right? Now, before we do that, we made an assumption that the rates move together. Is it a good assumption, right? As always, we know that in finance and economics, we make a lot of assumptions. Sometimes we have to work with them, but it's also good to see whether it works or not. So, what you would have, if that were true, is that if you take two different maturities, so maturities, let's say, 2 years and 10 years, right? And you look at how the 2-year rate changes over time, right? So here you have the change in, in the 2-year rate. Right. Here you have the change in 10-year rate. Right. So from one period to the next, how did this rate change? So if our assumption of parallel shift of the yield curve were right, whenever the 2-year rate moves in a certain way, the 10-year rate should move in exactly the same way. Right. So how do you test for that? Well, you look at different matrices and you can compute a correlation matrix. Yeah, and that's what you have here for Swedish government yields. You have the different maturity, and for each maturity, you look at the correlation between the change in the rate at this maturity with the change in rate at another maturity, right? Of course, as you know, this matrix is symmetric because the correlation between X and Y is the correlation between Y and X. So we only need to report the lower part. And of course, in the diagonal, all these coefficients are equal to 1, right? Now, if our approximation were exactly true, what kind of numbers would we find in this table? Yes?
I guess it will be perfectly correlated, so it will be ones.
Yeah, it will be all 1 everywhere, right? Because that's the only way that our assumption could be true. So what you see here is that it's not quite the case, right? There's still some hope to the extent that, if you look at short maturity here, so you focus on this part here, which is short maturity. as well as the part at the bottom here. Long maturity. Well, the correlations are not one, of course, we don't expect to find exactly one, but they are pretty close to one, right? So, doesn't work perfectly to the extent that the short-term rates do not seem to be super correlated with the long-term rates, although the correlation is positive. But at least, if you look at maturities that are pretty close, you have this correlation. So what we take away from that, well, the approximation that we're making is an approximation, doesn't always work. And what it means, in fact, is that it only accounts for a portion of the interest rate risk, right? So what we're saying here, in a sense, is that with that model, we do as if the only thing that can change is the level of the yield curve, right? Remember the picture I showed you before? Start with the yield curve and you ask, what if all the rates move by the same way, right? Now, the yield curve might move in different ways. And later on, we will see that, if you really want to hedge all types of risks that you face with yield curve movements, you can actually do that, right? But here we're just going to focus on one measure, which is duration, which tells you how sensitive a bond or portfolio is to this parallel shift in the yield curve. So how do we do that? Well, as I said, we're going to approximate the bond price function. And here, in this slide, we make one more assumption, which is that the yield curve is flat. But I just want to be clear that we do not need this assumption, right? This is the footnote in the slide. We do not need to make this assumption. It's just makes it easier. So, okay, what we know is that if you choose a certain level of rate, right? So R0 here, and suppose you want to approximate the bond price function close to that R0 here, right? So suppose R0 is 1%, but that doesn't really matter. So you want to know how the bond price will change close to this 1%. Now, what we know is that you can approximate this P function, which is complicated because it involves, inverse power of the interest rate with simpler functions, right? And the simpler approximation that you can come up with, as you probably know, is the linear approximation. Right? Now, why is it linear? Because as you can see here, the price for a new value of the interest rate R is the old price. Okay, so that's a constant. That's the price at R0. Here, what is this thing? Well, as you can read here, this is the first order derivative of the function, right? So that's also a number because that's evaluated at R0. So the only thing that depends on R is this term, right? So that's why this is a linear approximation, right? So around the function, you approximate it with a linear function. And in a sense, what it tells us is that, if you want to approximate interest rate risk with this first order approximation, there's only one thing we need to know, one number, which is the first order derivative of the price function is P1 R0, right? And as we can imagine, this would be very related to the concept of duration, right? This is how much the price changed locally close to this point R0 with the rate. So sometimes, a picture is better than a long discussion. So let's look at that, with a 10-year bond that has maturity 10 years and coupon rate 10%. Right? So we're going to look at movements close to this value, right? So we suppose that today the rate is 10%, 0.1. And what you see here is that, well, the bond trades at par. It's not very surprising because, the coupon of this bond is 10%. If the interest rate is 10%, we know that the bond should trade at par. Okay. Now, what you have here on the graph is in red the actual price function, right? So this is exactly what you get if you plot that function here. And in blue and green, you have the approximation, right? So as you can see, the blue one is linear, right? We approximate, the function in red by the tangent at this point at 10%, right? This is your blue line. Now you also have the second order approximation, which is a quadratic function because it involves quadratic terms of R minus R0. And what we see, of course, is that the second order approximation is a better approximation of the function, right? And as some of you might know, if you keep on increasing the order of the approximation, you have what you call a Taylor expansion, and this Taylor expansion will be closer and closer to the function, right? But at some point, you don't care because what you want is an approximation, right? And the first order approximation is great because you only need to know one thing, which is the slope here of the blue line, right? So here, if you look at the movement of interest rate from here to, let's say, 15%, sorry, yeah, 15%. Okay. Here you have the change in rate, and here you have the change in price, right? And if you walk along the blue curve, which is linear, the only thing you need to know is the slope of that function, right? And how fast the price decrease with the interest rate will be determined by the derivative of the price function. Okay. So that's why we need to compute this object. The one thing you can see is that, what we're going to do is that we're going to approximate small changes in price with the blue curve as opposed to the actual red curve. And that's, as it's written here, this linear approximation is in fact conservative. So what do I mean by that? Well, suppose that you approximate the new price with the blue line. Right? If the interest rate increase, what you're going to say that the price decreased more than what it actually decreased. Why? Because the blue line is below the red line. Okay. So that's why you're conservative, because you overestimate the impact of an increase in rates. Now, what about the upside? So the upside for a bondholder is that when interest rate decrease. So when interest rate decrease, again, the blue curve is below the red curve. So you're going to say, yes, my bond increases in value, but you would not say that it increases as much as it actually does if you look at the actual price function, right? So that's why it's being conservative. You overestimate the loss if the interest rate increase, you underestimate the gain, right? To the extent that this duration measure will be used for risk management, it's not necessarily a bad idea to be conservative, okay? And just a question, why is the blue curve, so why is the linear approximation always below the red curve? So this is not just this picture, that if you do it for every point, 10%, 5%, 15%, you will always find this. And it's related to one of your favorite concepts, I'm sure. Yes?
Is it because it's the function for the price is convex?
Yes, exactly. It's related to
The
convexity.
derivative always goes from.
Yeah, so it's related to convexity again, right? So the fact that function is convex means that if you take the derivative, this line will always be below the function itself. Later on, we will see that because we make this linear approximation and there's convexity in the price function, we're going to see that we miss a part of interest rate risk, and this part can sometimes be important. So the idea is that some people will trade on the fact that this price function is convex instead of just being linear, but that's for later. For now, we're just going to focus on this one, the first order approximation. All right. So what did we say? We're gonna approximate to compute how the price is sensitive to interest rate. We're gonna approximate it with the first order approximation, and we said on the last slide that for that we only need to know one number, which is the derivative of the price function. Okay, so that really simplifies our life. Now here, this example is just to show you that if indeed the change in yield is small, you get a pretty good approximation, right? So again, what we're doing here, this is just another way to write the derivative. You can use the way you prefer. I don't really care. You have the new price, right? So what you have here is the old, right? And here you have the change. Okay. What we say is that the new price is going to be equal to the old price again, plus the change in rate multiplied by the derivative of this function. Okay. So it's obvious, this number we know is negative, right? Because when the rate increases, the price goes down. And the more negative it is, the more the price will change, okay, for a given change in interest rate. So here, this picture tells you, okay, what if we compare the approximation? So, this one, again, this one is an approximation to the actual change in price, right? Just to see whether, in an example, whether we're pretty close. Okay, well, I give you an example here. You have a 10-year bond with coupon rate 5%, and the rate is initially 6%. Now, one thing you know for sure is that, well, it pays 5% coupon, the interest rate is higher than the coupon rate, so the bond has to be a discount bond, right? Why? Because it pays a coupon that is lower than interest rate, so investors need to be compensated with some capital gain between the price today and the face value of 100 at maturity, right? Now you can compute the actual new price, right, which is this one. So that's, that's not making any approximation. And then you can compare it to the approximated new price, which is this one here. What you see is that, well, the difference is just 1 cent. Okay, so it's not that big. So of course, 2 comments on that. First, here the value of our position is just $100, right? So 1 cent on $100, you might think it's not a big deal. Of course, if you have a much larger position, you're going to start worry about the fact that this difference can be quite large, right? So you might correct for this thing. The other important thing I want to say is that here the change in rate that we consider is pretty big, right? It's 0.2%. In practice, from one day to the next or from 1 month to the next, interest rates do not move by 0.2%, right? They move by very few basis points, percent of percent. The way to say this in the graph is that, of course, if you approximate the red function by the blue function and you stay pretty close to this point here, you're going to do a pretty good job, right? But if you look for a big change in interest rate, yes, there's going to be a significant gap, right? And again, that's why we do an approximation. We think that the change in rates that matter are typically small changes in rate, right? So that's why we take this approximation. All right. So here we have a couple of definitions. Okay, so these are just things you should know, right? I mean, that's for sure. This formula, if you need it in an exam, I won't give it to you, to the extent that they are fairly, I think, simple to remember. So we have two concepts of duration, right? And by the way, I didn't tell you yet why we call it duration, but this will come later, right? So here you could think, okay, this is a measure of interest rate risk sensitivity. Why do we call it duration? For now, it doesn't really make sense, but we're going to see that there's a reason why people actually call it duration. So the way to remember this is that the dollar duration is basically the change in price when the rate change. But of course, this is not a relative price, right? So if your price changes by a lot, it might just mean that initially, you had a big position, right? So if your position moves by $2, it's not the same thing if your initial position was $100 or $100,000, right? So what you come up with is modified duration, right? So modified duration is the relative change in price. Okay. You take the dollar duration and you divide by the price. Again, remember that there's a minus here, right? So that duration is positive. Okay. If you didn't have the minus, the derivative is negative, right? This is a downward sloping curve, so you get a negative number. We like to work with positive numbers, so we put a minus. Okay. It's kind of easy in an exercise. If you ask to compute the duration and you get a negative number, you probably forgot to take the minus sign, right? So it's not too complicated. One thing in terms of terminology, in problem sets or in the exam, whenever I want to refer to the dollar duration, well, I will actually call it the dollar duration, right? Because that's the name. Now, just to save, notation and time, when I mention the modified duration, sometimes I will not say modified. I will just call it duration, right? So, maybe you won't remember that now, but this is just what you might find in some questions. If I mention dollar duration, I always say dollar duration. If I mention modified duration, I sometimes call it modified, sometimes just duration, right? So you cannot be confused because at least this one is always called by its actual name. Okay. Any questions so far? No, I'm also looking at the chat if somebody has a question. All right. So we're going to do this slide and then take the break. What we do here is how to make sense of this concept, right? So what does it mean that a bond has a duration? Let's look again at the. This is not. Okay. This one here. That's what I wanted to show again. So what does it mean that a bond has a certain duration? And by the way, you see here that duration is quoted in years, right? And again, because duration refers to years. For now, we don't know why we call it 5.3 years, right? It doesn't make sense. It's just a derivative of a price function. Again, we're going to see later why there's a relationship between this concept of duration and another concept of duration, which actually refers to an amount of time. Okay, so again, what does it mean that this portfolio has a duration of 5.3? How do you interpret that number? But you're going to see that it's fairly easy. And we're going to do it in this example. Okay. Okay, so again, we take our 10-year bond with coupon rate 5%. The interest rate is currently 6%. And you can do the math. Actually, there's an example in the slides for you just to make this computation of the dollar duration and duration. It's just taking a derivative. So if you know how to take a derivative, this is super easy for you. Otherwise, you have this other slide that I will show you next, I think, with the steps. Okay. Suppose we look at an absolute increase in the rate by 1%. So why do I say absolute? Because here it's the rate moving from 6 to 7%, right? It's not a 1% increase of the 6% rate, right? So that's what I mean by absolute. So first, this is a big increase in rate. As I just said, typically over a short period, interest rates do not move up or down by 1%. This is just to have the idea. Now let's look at the formula that we have above, right? So to compute the new price, we take the old price, right? And we subtract dollar duration times the change in rate, right? Again, remember the minus sign because dollar duration is if the minus over R, right? Minus the derivative. Okay. So if we just plug in a number, it tells us that, well, the decrease in price here, which is going to be, so if we do PR plus delta R plus PR, just using the formula above, is going to be minus 114 times 1%. Okay, I'm just applying this formula here. Okay, so 700 more or less multiplied by 1%, you get $7, right? It's the dollar duration. So here you get an amount in dollar. As I said, if you know the value of initial position, yeah, having the value in dollar is good, but what you might care about is the relative change in price, right? And what we know is that this is taken care of not by dollar duration, but by duration itself. So if you do the same exercise for duration, now I want the relative decrease in price. So what I'm going to do here is that I'm going to compute PR plus delta R. I divide by the initial price. What do I get? I get minus D times delta R. And this is minus 7.57, sorry, times again 1%. Okay. So here you end up with a relative price change of 7.57%. Right? So duration is really easy to interpret. If you get the duration, it just means that if interest rate move up by 1%, your portfolio moves down by D%. Right? D here is 7.57, so that's why you get that number. Right? So again, remember the example by Vanguard that I showed you. It was saying that the duration was 5.43, I think, which means that if interest rates move up by 1%, the value of that portfolio will go down by 5.43%. Right? So that's the measure of interest rate risk that people care about, and that's the one that is typically reported in a bond fund. Right? If you invest in a bond fund and you don't find the measure of duration, I would worry, or at least I would ask the manager to report that measure. Right? It's a bit like if you invest in an equity portfolio, you don't know the volatility of the stocks that you invested. Right? This is kind of the same type of problem, I would say. And finally, just a question of terminology. Although we are not going to use this that much. The point again is that here I made you look at a change in rate of 1%. Right? So from 6 to 7, that's pretty big. That's not the typical change in interest rate that happen over the course of a week or a month. So what traders in fixed income often look at is the price value of a basis point, right? So what is a basis point for those who remember? It's a percent of a percent, right? So if you want, it's a 1/10,000th, right? But what we talk about is basis point. So the idea here is that typically the rate will not move from 6 to 7%. It will move from 6 to, let's say, 6.10%. Right, and that's a change in 10 basis points. Okay, so that's the way people think about changing rates. Okay, so basically they want to have this notion of how much the price changed by 1 basis point. So what they compute is called the price value of a basis point, which is simply you take the dollar duration, because here we want the absolute price change, and you multiply it by this percent of a percent. Okay, and the question you answer is how much the portfolio loses if rates moves by this 1 basis point, which is a percent of a percent. Okay. If you look at textbooks, you will find many different variation of that. Some people use different measures. What really matters is that you know what it means, that you focus on modified duration, or what sometimes I would call just duration, that you know that if the duration is D, it means that if interest rates increase by 1%, the value of the portfolio decreased by D%, right? And of course, it's a linear approximation, so it's also going to be true on the other side, right? If interest rates decrease by 1%, the value of your portfolio increases by D%, okay? So that's really, like the basic concept. It's not that simple, it's not that complicated. But you're going to see that with this simple concept, we can actually do quite a lot, and we can relate this concept to the examples I mentioned at the beginning with the bank, for example. Okay, we're going to take a break, and let's be back at 15. I just want to mention that, so it's not necessarily because of you, but I will have to run after the second class. So if you have questions about the problem set that you want to ask, please ask them at the break now, so that I can save the time before the next section for people of the next section. So if you have questions, feel free to ask them now. Okay, see you. So for you on Zoom, see you in a bit.
Now, Jim.